If one more buyer tells you they're waiting for rates to drop, I'm going to show you exactly what to say back, plus the rate predictions for 2026 that you need to know right now. Hey everyone, Layman here from True Title of Central Florida. Welcome back to the channel. Today we're talking about the elephant in the room, interest rates in 2026, because I guarantee you're hearing this from buyers every single day. Should we wait for rates to come down? And honestly, I get it. Rates have been higher than we've seen in years. But here's the thing. If you're waiting for rates to magically drop to 3%, you're going to be waiting a long time. So in this video, I'm going to give you one, what the actual experts are predicting for rates in 2026, two, exactly what to say to buyers who are waiting for lower rates, and three, strategies for both buyers and sellers in this rate environment that actually work. Let's get into it. Okay, so let's start with where we are right now. As of this week, Freddie Mac has the 30-year fixed mortgage rate at just over 6%. Most buyers are seeing rates somewhere in the 6 to 6.5% range, depending on their credit score, down payment, and loan program. Now, I know if you've been in real estate for more than 5 years, you remember 3% rates. You remember 2020 and 2021 when we were refinancing everyone at 2.75%. Those days felt like a dream. But here's the context. Historically, 6% is not a high rate. Go back to the 80s and rates were 18%. Go back to the early 2000s, they were routinely 6 to 8%. Even in 2018, just 8 years ago, rates were pushing 5%. The 3% rates we saw during COVID, those were the anomaly. The Federal Reserve cut rates to near zero and pumped money into the economy because everything shut down. Those emergency measures created rates we've never seen before. So when your buyers say rates are too high, what they're really saying is rates aren't as low as that weird 2-year window when the world was on fire. And that's fair, but it's not reality anymore. This 6 to 6.5%, this is closer to normal. So what are the experts predicting for 2026? I've been looking at the major forecasters, the Mortgage Bankers Association, Fannie Mae, National Association of Realtors, and big banks. And here's what they're generally saying. Most forecasts for 2026 cluster around the low sixes. Some have us closer to 6.4% by the end of the year. Some as low as the high fives, but nobody, and I mean nobody, is calling for a return to 3 or 4%. So the expectation is rates stay roughly where they are, maybe drift down a bit, but we're talking about going from 6% to maybe 5.8 or 6.2 to 6%. We're not talking about a big drop. A lot of forecasts expect some easing in rates over the next couple of years, but nobody can guarantee it. Economic conditions change, the Fed's policies shift, inflation does unexpected things. And even if the rosiest forecast comes true and we end 2026 at 5.8%, we're talking about dropping from 6% to 5.8%. That's 0.2%. On a $300,000 loan, that's a difference of about $35 to $40 per month. That's it. So if your buyers are sitting on the sidelines waiting for rates to crash, they're waiting for maybe $40 a month in savings, while home prices are ticking up because inventory is tight. And the thing they don't understand is as rates drop, home prices go up. So it's really a chicken and the egg scenario. The math doesn't work in their favor. Okay, so here's exactly what to say when a buyer tells you they're waiting for rates to drop. I totally understand. Rates are higher than a few years ago. But here's what I'm seeing in the market. When rates dip even a little bit, more buyers jump back in and prices tend to move up a few percent because of the competition. So let's say we wait 6 months hoping for rates to drop a quarter point. That might save you about $50 a month. But if prices go up even 5% because more buyers are competing, that's $15,000 more on a $300,000 home. You'd save $600 a year on the payment, but pay $15,000 more for the house. Does that make sense? This usually gets them thinking because the math is real. Script number 2, and I'm just going to tell you up front, I don't love the language when it's used in a trite manner. However, there's some truth to the idea that you marry the house and you date the rate. Here's the strategy and here's the script. Here's the strategy a lot of smart buyers are using right now. Buy the house you want at today's rate, then refinance if and when rates drop. You lock in the price now before it goes up, and if rates do come down later, You get the lower rate then. It's the best of both worlds. Here's the thing about this strategy. A lot of forecasts expect some easing in rates over the next couple of years. Nobody can promise it, but if it happens, your buyers can refinance. They're not stuck with today's rate forever, but if they wait and miss the house they want, someone else bought it and it's gone. You can always refinance the rate. You can't refinance the house you didn't buy. All right, so let's talk actual strategies your buyers can use right now in this rate environment. Strategy number one is temporary rate buydowns. This is where the seller or builder pays to buy down your buyer's rate for the first year or two. So instead of 6.5%, your buyer may pay 4.5% the first year, 5.5% the second year, then 6.5% in year three. This gives them breathing room while they adjust to the payment. Builders are doing this a lot right now. If you have buyers looking at new construction, ask about buydown. Strategy number two, adjustable rate mortgages or ARM. Now I know ARMs got a bad rap in 2008, but hear me out. A 5-1 ARM or a 7-1 ARM can give your buyer a lower rate for the first 5 or 7 years, often half a point to a full percentage point lower than a fixed rate. Then it adjusts. If you're planning to refinance in the next few years anyway, an ARM can save you money right now. Talk to a lender about this. It's not for everyone, and they need to do this responsibly. Home prices don't always go up. They need to be aware that there are some risks in taking on an adjustable rate mortgage, but it is a tool in the toolbox. Strategy number three, focus on the total monthly payment, not just the rate. Your buyers are fixated on the interest rate number, but what they actually care about is the monthly payment, right? So help them see the full picture. A $350,000 house at 6.5% with low HOA fees and taxes might have the same monthly payment as a $320,000 house at 6% with high HOA and taxes. Show them the full numbers, principal, interest, taxes, insurance, HOA. That's what they're actually paying every month. Sometimes a higher rate on the right house is cheaper overall than a lower rate on the wrong house. Strategy number four, seller concessions for rate relief. In your offer, ask the seller for a 2 to 3% credit toward closing costs or a rate buydown. In this market, if a house has been sitting for 45 to 60 days, sellers are often open to this. Use that concession to buy down your buyer's rate. On a $300,000 purchase, a 2% concession is $6,000. That can buy down the rate by 0.5 to 0.75% for the first few years. It makes a huge difference in the early payments. Those are 4 strategies you can use today with buyers who are rate sensitive. Now, quick word for your sellers because they're impacted by rates too. If your seller bought or refinanced in 2021 at 3%, they're sitting on what we call a golden handcuff mortgage. They don't want to sell because they don't want to give up that low rate. Here's what to tell you. I understand you have a great rate, but if you're staying in a house that no longer fits your life, it's too big, it's too small, or it's the wrong location because you're afraid of rates, you're letting the tail wag the dog. Your life should drive your housing decisions, not your interest rate. And remind them they can use those same strategies we just talked about. Rate buydowns, adjustable rate mortgages, seller concessions, they're not stuck. Plus, most sellers who bought before early in COVID have seen significant equity gains, especially in markets like ours. That means a bigger down payment on the next house, which shrinks the loan amount. Even at a higher rate, a smaller loan can keep the payment reasonable. So don't let your sellers get paralyzed by golden handcuffs. There's always a way to make the numbers work. All right, quick recap. 1, rates in 2026 are predicted to stay roughly where they are, maybe drift down to the low 6s by year end, but not down to 3 or 4%. 2, when buyers say they're waiting for rates to drop, use the scripts I gave you to show them why waiting often costs more than buying now. 3, use strategies like temporary buydowns, ARMs, seller concessions, and total payment analysis to make deals work today. If this was helpful, hit the subscribe button. I drop weekly videos with strategies like this to help you grow your business. And if you want a downloadable PDF with these scripts and strategies, drop a comment below or email me at clay@truetitleocala.com. I will send it right over. Remember, you can't control interest rates, but you can control how you respond to them. And the agents who figure this out, they're the ones closing deals while everyone else is sitting on the sideline.